Hello, everyone. Welcome to our quarterly Diamond Trends webinar. It's great to be with you all again today. We're in May, mid-May already. Time does fly. Whether the market's up or down, time moves on, and we're approaching the JCK shows. And it's kind of an interesting time in the market. This period, the second quarter is traditionally a slow period for the diamond industry, but there's this sort of sentiment out there that this year is a bit slower than usual. And so that's what brings us here today. The title of this webinar is Why the Diamond Market Has Slowed. And it's a big question. It's a big topic. So I guess maybe the small print is that it's these are theories, and we're just trying to understand what's happening in the market. We're trying to understand the forces behind that are shaping the diamond market on a continual basis. And so we find ourselves here in the middle of May, in a pretty quiet market situation. We want to just understand why that is the case. So our goals for today are as I said, understand the market. That's the whole point of the Diamond Trends webinar series, which we've been doing for I think it's four years now. It's quite amazing. As I say, time flies. But we're going to look at in the next hour or so the current price and inventory dynamic. What's happening in the wholesale polished market. We'll obviously see that downtrend, which I think you're all probably familiar with, but you'll see it in graph form. And we'll then spend some time trying to understand what is behind the slowdown. What are those forces that are causing the decline in prices? And the decline in prices is a reflection of a slowdown in the market. That's economics 101. So we'll spend some time understanding the slowdown. Then we'll look at the state of retail, and that maybe already gives you a little hint as to what are those forces that are behind the slowdown. But we'll spend some time looking at the state of retail, and then very briefly we'll look ahead to without making too many bold predictions, because I think it's quite an impossible task to predict what will happen in this market anyway. So let's get to it, and we will have some time for questions, and so feel free to please put your questions in the Q&A section, because I'll be looking at that at the end of the webinar to call out your questions. And then feel free to chat amongst yourselves, and we encourage a dialogue. And that's the whole point of these webinars, is to stimulate dialogue and engage with each other to better understand the market. Okay, so let's get started. Our traditional graph here, looking at the last year and a half now, almost a half. From the beginning of 2022, we saw this uptrend at the beginning of the year, and it lasted through to around March, April 2022, and that was the recovery from COVID. And we'll touch on that theme again during this presentation. Because the market needs to be understood in the context of what's happened in the last 3 to 4 years. But this graph sort of hints to that context, that we had this very strong recovery in the diamond market, in the jewelry market, and that fed through to the wholesale trade. And then from around mid-March, I think towards the end of March, I think coinciding with the Russia-Ukraine war, frankly, but we've said in previous webinars that that's not really the cause. That contributed to the negative sentiment globally, but really it was also this period when the Fed started to raise interest rates, that we started to feel the full effect of inflation, and it's kind of if you're a graph junkie like myself, it's almost like poetic how the timing works out, how the market responds to those, or coincides with those sort of economic those economic factors. But there has been the graph demonstrates that there has been a steady downtrend, and I would focus on that black line, which is the 1 characters and kind of the core of the American market, I would say, that prices continue to decline and have been on a decline ever since then. The 30 pointers have shown some strength in this year, which is a whole separate webinar, I think, maybe that the 30 pointers, maybe it's I think there was a strong reduction of inventory in those goods during the past year, and so we see that lower inventory, that lower supply has supported prices, but it has stabilized in recent months, as we see on this graph. So, but the general downtrend in the other sizes, and particularly in those 1 characters, is down and continues to be trend downward in this week already. As we always like to do, to show it on a quarterly basis, again, we see the recovery in the market over 2020, over 2021 and 2020, and the beginning of 2022, at least that first quarter. But then we've had 4 or 5, let's say 4.5 quarters of a negative trend in the RapNet Diamond Index, the RAPI for 1 characters. That final bar, that 3%, is for April through the half through to May 15, through May 15. So it's half of the quarter, and the downtrend is continuing, as we see. But I think again, it's all in that context of the last 3 years, and we'll see that also in the jewelry market when we get to that, when we speak about retail, that that this graph demonstrates quite nicely that that there was the strong uptrend, the strong recovery after COVID, that we're now experiencing a correction from that, and so I would just always keep that in mind. As always, this graph shows since the 2008 crisis, that we had those ups, we had those downs during the crisis, during 2008 financial downturn, and then that strong recovery, which was driven by the expansion into China, and became kind of speculative. As we see the sharp increase towards the end of 2010, 2011. And then the market's been on a correction path since then, over the last decade. And of course, COVID happened, the market shut down, but then the market recovered beautifully. And we had the strong increase in prices in 2021 and 22, first half of 22. But the last year has seen this downward trend, and a fairly sharp downward trend as well at that. And so, I borrowed this slide from Martin's presentations that he's given in the past, but it's important to understand just the basics of what influences price. Price is a function of supply and demand, and so prices decline when there's an increase in supply, or a decline in demand, or both. And prices rise when supply declines. So if there are fewer goods in the market, it supports prices, or if demand increases, it also supports prices. We saw in 2021-22 that demand increased, and that really pulled the market up with it. At a retail level, demand increased. We had record years in the last 2 years. and that pulled the market, pulled the wholesale market up, pulled the rough market up with it. And so prices rise when either supply declines or demand increases. The increase in demand is the most powerful element there. And so there is a question that's being asked at the moment, you know, throughout the last year, since the Russia-Ukraine crisis, that we know that there are sanctions on Alrosa goods, on the Russian goods, and so there is which accounts for 25 to 30% of the global rough supply, and we presume that those goods are not on the market, or a large proportion of those goods are not on the market, and so that should signal a reduction in supply to the market, and that would then signal that should support prices ultimately. But we haven't seen that that's happened. We have seen that those Russian goods are not on the market to the same extent that they were pre-Ukraine crisis, but we don't see that the lack of Russian supply is supporting prices on the market. So why has that lower supply not supported prices? And that's a big question for the market. And so that points us to inventory levels. And so what's happening with inventory in general? And you know, our data on RapNet suggests that inventory levels are still relatively high in the polished wholesale market. You know, and this shows just how high that is. It's come down a little bit from its peak at the end of 2022, and the inventory on RapNet does have some seasonality to it. You know, just heading into the holiday season, there are a lot of goods that we see on RapNet typically, and sort of in that third quarter, and we see that in this graph over here. But inventory levels have come down a little bit, but they're still historically quite high. And you know, we just have to look back to 2015, 2016, particularly 2018-19. You know, a big theme in our webinars back then, if we were doing webinars back then, I can't remember if we were, but a big theme in what we were reporting and how we were analyzing the market was that there was a spike in rough supply coming to the market in 2018-19, and that pushed polished inventories up, and that's what influenced this decline over here that we saw over here in polished prices. So back in 2018, 2019, we were then saying that polished inventory levels are historically high, and that's why we are seeing a decline in polished prices. And by the way, that rough supply increased in 2017, 18, 19 because there were two or three big mines that came on stream. The Gachakwe mine, the Likabong, I think, came on stream into the market at that time, and was it Renard? I forget, but Gachakwe was the big push that pushed rough supply up and pushed polished inventory levels up. But we see now that polished inventory levels are still higher than even those levels. And so they're historically high. And so immediately we, you know, relating back to those Russian sanctions, which are keeping 25 to 30% of rough supply off the market, you know, it's even with that element of the supply chain blocked, we still have high polished inventory. And so that sort of cancels out the theory that the lack of Russian goods should support polished prices. And so inventory levels are high, and that gives us some understanding of why polished prices continue to decline. But it's important to look at the goods that are coming into the market. And so when we've said before that India is the big indicator for us of what's happening at a manufacturing level. That India accounts for a good 90%, or estimated 90% of all polished production, rough to polished production. And so what the rough that India imports indicates how the sort of the demand for all manufacturing levels, let's say, and the polished that it exports is again an indicator of what's coming out into the market. But I just want to focus on India's rough imports for a second, and I will point you to from 2020 onwards, because, well, even before then, if we look at 2019, actually from 2020 onwards, there was a sharp decline during the lockdowns of rough imports to India, but then there was a sharp increase and recovery, and taking the averages, it probably all sort of flattens out and isn't too alarming. But March 2021, there was pretty aggressive rough buying in the manufacturing sector, and so and remember that manufacturers went into COVID with relatively high inventory. They did manage to sell it off in 2020, in the latter half of 2020, when things came back. But then there was this aggressive sort of rough buying and coming back into the market, expecting and experiencing a surge in demand from the retail and from the polished sectors. And so we see here that there was this increase in rough buying in 2021, and that tapered off a little bit in 2022. But in the latter half of 2022, so did demand. And so again, I look at the rough sort of buying patterns over the last 2 to 3 years, and it gives me some understanding of why polished inventory levels are still high. And a big unknown in the market. Again, why is rough buying still within the historical range when all those Russian goods are not available for sale? And so from what I see in the data that's available, and there is less data available since sanctions were imposed on Russia, since Alrosa sort of became a bit shy, or stopped publishing its data points. And we used to publish great data. We used to get some really good insights from Alrosa. So in that sense, I miss the company's reports. But there are some government data points that we're looking at that give us some indication that there is still some buying of Russian goods coming into and Russian goods coming into the market. And so the government data from India's Commerce Department and Belgium's National Bank of Belgium break down rough imports by country. And so the combined rough imports to those important markets, if India is the main manufacturing center, Belgium has historically been the main rough trading center. And so we see obviously a drop off in demand or in imports to those centers combined. By value, from 2021 to 2022, there was a drop of 5% by value of imports of Russian rough to Belgium and India. By volume, the decline was by 46%, and there seemed to be a shift to larger, sort of more expensive goods. The average price rose by 76%, and these are all sort of our Rapaport calculations, just based on those data points. Looking into this year and what's happened so far this year, And this is based on, this is January, February. I didn't indicate that on the graph, so I apologize for that. But for January, February, comparing January, February 2021 to 22 to 23, we see that year on year, this year, the numbers are slightly down by 3%, 3% by value. Sorry, that's yeah, that volume number is not correct. It's not 2023 to 2022, but it's versus 2021. So compared to 2021 and 2022, oh, sorry, it's a mouthful. The volume of goods came down by 43%, and that's the orange bar chart. And it was slightly down in this year. But the point is that there are still some goods coming to the market, and last year we saw about 2.4 billion, about 2.5 billion dollars worth of Russian goods coming into Belgium and India versus 2.6 around 2.6 billion dollars worth last year. I'd rather count carrots, frankly, in this sense. It's because it's more dramatic. The volume of goods dropped in 22 to around 15, 16, 17 million carats versus just over 30 million carats in 2021. Of course, India and Belgium are not the only destinations for Russian goods. There are other markets for it, and I think there are probably, and I'm surmising here, but there are probably new markets for Russian goods that have opened up, but it's all sort of speculation. But the point here is that there are still goods coming in from Russia, and of course this weekend coming up, there's a big meeting of the G7 nations that will be we expect some sort of an announcement as to the new measures that all those G7 nations will adopt with regard to disclosures of goods coming into the country into those respective countries to ensure that they are not sourced in Russia and ultimately funding that conflict with the Ukraine. Okay, so we see all of that has proved to us that it's not a supply issue. I mean, supply is up, and so that's contributing to the decline in polish prices. But supply being polished inventory levels really. Why are polished inventory levels so high still? And the bottom line is that it's demand. The market is down because there is less demand that we're experiencing this year and the second half of last year for natural diamonds. So when we pose the question to members of the trade, there are two things that two aspects that people generally point to, and I would agree with them, but I would disagree with the emphasis that they put on each of those. And so the first thing that they would say to me is, Avi, the market is down because lab grown is cannibalizing the natural diamond market. And then the second thing is that, there's all this economic recession talk, etc. But their emphasis is on the lab grown market. I would flip it around. I think I would agree. And the next few slides, we're going to talk about both elements. I do think that the lab-grown market is having some sort of an effect on the natural diamond market. But I think the main issue affecting the current slowdown in diamond market activity is the caution that's coming out of the United States regarding the economic prospects and the economic conditions that the country is engulfed in, and I think globally as well, there is a lot of uncertainty as to the economic, the economics of the global economy and what we can expect in the short term. So let's look at synthetics first. So firstly, the lab-grown synthetic, lab-grown challenge. Lab-grown is growing. There's no doubt about it, and but it's growing from a low base, and so we would expect from this sort of low base that there would be these high sort of digit growth numbers. But the point is that it's growing. It's still, as far as I understand, and in talking to people both in the retail and the wholesale space, but more in the retail, I think it's still below 10% of the overall jewelry market. And I think that's important because we are here, it generates headlines when we hear that that this company's launching a lab-grown collection or starting to sell lab-grown goods. It generates headlines, and so we tend to think that the proportion is higher than it really is. But our understanding is that it's still within the region of 10% and probably just slightly below that of the overall jewelry market. The point, though, the more important point maybe is that that lab-grown is among the higher profit margin items that a jewelry retailer can hold or offers. And so there is incentive for retailers to continue to sell lab-grown. And that's even as wholesale, we know, famously lab-grown prices have come down dramatically in the wholesale market. But my understanding is that it doesn't affect that retail price. In fact, retail margins on lab-grown jewelry has edged up even, I think, even by a percentage point here or there, to in the last year even of this slowdown. So retailers are able to maintain their price points, or at least maintain their profit margins. They may reduce prices a little bit on the lab-grown side, but not as much as they're paying for it. It's about their cost. I think that's come down significantly. The big surprise of the last year or two in the lab-grown market is the extent to which it's tapped into the bridal market. The initial projections were always that lab-grown was going to take market share from the melee market or the cheaper goods, but bridal is its sweet spot, and that's something the industry, the natural diamond industry, needs to be pretty proactive about in sort of protecting its position in that bridal market. But so it's 1 to 2 caraters that are doing well for retail jewelers. But the lab-grown market's not without its challenges, and it's also in flux. It's also changing and facing headwinds of its own. And we have seen a bit of a slowdown in demand in the lab-grown space. And I think there are many it's sort of these, I see it as teething pains that this lab-grown market is developing and going through constant change and trying to find its place in the market. And so we saw this steady increase in exports of lab-grown polished from India. And those exports have come down a little bit in the last 2 to 3 quarters. But there are other issues at play here. It's not necessarily a reflection of a slowdown in demand. What we do know is that there was a rush, a wholesale. It was kind of a diamond rush in a way. As lab-grown was offering those those attractive margins at wholesale as well through 2020, as we came out of COVID, frankly, there was a rush into that market. And so I think there is a sense that there is an oversupply. There are a lot of goods, a lot of lab-grown goods in the market at the moment, and that's affecting prices. Prices have been declining at the wholesale level. And also, I think it's important to understand that just because it's a lab-grown product, jewelers don't, they approach it in the same way as they do other products. They're taking goods on memo. They're buying for programs, and so the wholesale market is adjusting to that dynamic as well. But the point is that wholesale prices continue to decline as supply has increased, and there is that feeling that there is this sort of that supply outweighs demand at this point in time, but it requires a little bit more nuance. There also, from what we're hearing, there is some consolidation and in the midstream, in the wholesale dealer market or growing market even. As I said, there was this strong sort of rush to get into lab grown over the last 2 years, and now as wholesale profit margins may be tightening, the larger companies, those larger Indian manufacturers who operate at scale and have the means to do so, are extending their reach across the supply chain. There is a sort of trend towards having vertically integrated lab-grown diamond companies. That includes their growing facilities, their polishing cutting and polishing capabilities, and then moving into the jewelry space as well. So supplying the jewelry to brands or retailers, or selling direct to consumers as well. And that's something we're starting to see more of and hear more of, that there are stronger Indian manufacturers who are extending themselves across the lab-grown supply chain, and that's squeezing out those many smaller players that sort of jumped into the lab-grown market as the market was growing. So it's if we take a few takeaways over here, the first is that it is growing. It's a growing market. Prices are declining, and there is change in how that business is operating, and so it's kind of in flux. But to relate it all to the natural diamond market is that there is the sentiment that lab grown, because it's an emerging industry, it's growing at a pace, and it is taking some. It seems to be taking some market share, or growing for retailers at least, and that's changing the way retailers, the makeup of their inventory, and we'll get to that in some time. But as I said earlier, the bigger impact, in my opinion, on the slowdown in natural diamonds is the economy, and maybe not necessarily the economy as much as the sentiment that's within about the economy that we've been hearing. We've experienced high inflation, as this graph indicates in the orange graph, the orange line. And to curb that inflation, the Fed has steadily raised interest rates, and all that spells to a higher cost of living for households in the United States. And so the Fed is raising interest rates. They want inflation. Their target is to have inflation of between 2 to 3%. Inflation has come down in the last since its peak in around June, I think it was last year, but it's still historically high. It's still above that 2 to 3% range that the Fed wants to keep it at. It's I think it clocked in at around 5% in April or May. And so we still see this sort of cautious sentiment coming out of the Fed in their minutes from the May rate decision, where they increased rates by a 0.25 percentage point. They said economic activity expanded at a modest pace in the first quarter. The tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. And so not exactly a big confidence boosting message. And the point is that that sort of sentiment, that sort of cautious sentiment about the economy continues to be with us and affect the way we operate in business, whether it should or not. It's maybe human nature that it does so. This is, I think that, the amount that US households save on a monthly basis is a great indicator to how we can, the prospects moving forward. Historically, households would save an average of 5%, around 5-6% of their disposable income. That shot up during COVID, as we see in the spikes from these in this graph. As people saved more, they weren't, or let's say they weren't spending as much as they used to during the lockdowns, and they received those stimulus checks that boosted their income or their available available funds for things like discretionary spending, such as on jewelry, etc. That obviously came down as those stimulus payments didn't, they were not like diamonds, which are forever. They ended. I think we saw 2 or 3 payments, and then people came out of COVID and spent, and they spent a lot of those savings that they had managed to ratchet up during the lockdown period. And so that percentage of savings savings as a percentage of disposable income came down to a near historic low around the end of last year. And it slowly sort of crept up to around 5% where we're at the moment. And so if we see that continue to rise, that would, I think, be a good indicator or a good omen, at least, for the retail space moving forward. But as we saw in the previous graph showing the inflation and the interest rates, that the cost of living is rising, and so it could be also an indicator that people are just being a bit more cautious in their spending and saving for a rainy day, which would it may reflect also just a general uncertainty that people are steadily saving more because they're more uncertain about what's happening in the economy. We looked at the state of retail in the recent, we published end of last week, the May Rapaport research report. We also are publishing these and many more articles on the state of the US market in the May Rapaport magazine, which we're going to print tomorrow, so we're kind of on deadline, very stressful around our editorial team, but that's our cycle. And that magazine will be available at the JCK show. But I do want to share with you some insights that I came to or came across in researching those articles. The first is that general retail continues to, well, it has increased in 2023, the latter half, even through to, we see again here that through 2021 and 22 there was a strong increase in retail sales, and this is general retail sales, not just jewelry. It has stabilized and plateaued perhaps in this year, but it's still again showing some gains, at least over pre-COVID, and in fact gains over last year even. When we look at the jewelry market, which I'll return now to that context that I want you to keep in mind over here, that 2020 was an anomaly year for the industry. We had COVID, we shut down, we couldn't sell, and so sales dropped. But 2021, there was a really beautiful recovery in the market. We had a record year for jewelry, for diamond jewelry, and the point here is that 2022 pretty much matched 2021, and that is a phenomenal achievement for the industry. And it was really riding on the coattails of 2021. That first half of last year was still a strong period. And so when we see negative numbers at the moment in this period now, we've got to always keep in mind that we are comparing to it's against pretty high comparisons. And so we saw that the 2022, the holiday season, was down by about 5%, 5.4%, according to MasterCard. And the Edge Retail Academy estimates that general jewelry sales and profits, by the way, were down by 5% in the January to April period. By volume of units sold, the Edge estimates that that sales were down 3%. So, when you just take those numbers on their own and without looking at sentiment, without looking at what people are saying, they're actually pretty good numbers, I think, because again, in the context of those record years of 2021 and 2022, a 5%, a decline of 5% in this market is I think very encouraging. It means that we are still well above pre-pandemic levels. MasterCard, just again putting it in context, these are the strong numbers that we saw in 2022, which was against 2021. That jewelry sales rose by 20-30% in the teens. These are all really encouraging numbers, until the turning point was around July, August, where August we really started to feel the effect of inflation, and so we saw a slowdown in the growth. And pretty much in the second half of last year and into this year, that we're seeing sort of negative numbers, but it's sort of in those low single-digit percentage declines. So I think this graph is a really interesting trend that it's a good graph to keep in context, but it also shows us the turning points, where the sentiment changed. And sort of changed in the second half of last year. And that's what's really affecting the market. Again, when we look at the title of this webinar, what's behind the market slowdown, it can't be these numbers, because these numbers are still pretty encouraging. I think it's more about that turn in sentiment. How are businesses, how are households responding to the recession talk, to the high inflation, to the sentiment that's put out there, as in how we assess the general economy and the market in general. And so some observations that are picked up on, that firstly, jewelers are selling. If sales are down just 5%, compared to record years, it means they're still doing some business there. And so jewelers are selling, but they're not buying. And that's where the sentiment comes in, that they are not buying. They're being more cautious about their inventory management. And that may be a mistake, even from a jeweler's point of view. My understanding in speaking to one or two consultants in the industry, they expressed concern that even those top sellers, of jewelry that they're selling in the store, they're still, even those, they're careful to replace that inventory and go into the wholesale market, go into the diamond market to replace that inventory. And there is some concern that if you're selling, push on. It's an indication that there's demand for it, so buy. But there is definitely a difference in the way, between what jewelers are selling and what they're buying in the wholesale market. As part of being more careful about their inventory management, they have mechanisms in which they can do that. They're taking more goods on memo. And where they don't have, where the inventory risk is left with the wholesaler. They're buying more, and they don't need to necessarily hold that large inventory in their stores. They can sell using their online, using their digital capabilities, which they improved vastly during COVID. But another insight or observation that I came across is that jewelers, also are holding high inventory, and this surprised me somewhat. But because of all those mechanisms, we speak about them taking more goods on memo, using digital to sell, and then then ordering the goods once it's bought. But that pattern of that we saw in the diamond market of being restrained during COVID, coming out of COVID and buying all that rough, if you remember that graph, we saw, from my understanding and the research that we've done for the research report and for the magazine, that jewelers did the same thing. They did all the right things during COVID, and they came out of COVID and bought a lot of inventory. And so they reduced their inventory in 2020, and then they bought aggressively as they were making great sales. The market was booming in 2021 and the first half, at least, of 2022, and they were buying. And so that left them with high inventory. And so there isn't necessarily a need to go back into the wholesale market on, if they are cautious about their prospects for moving forward. One data point that the Edge provided me was that the inventory turnover at retail is between 0.6 and 0.8 times per year. And so for a healthy retailer, the Edge Sherry from the Edge explained to me, you want at least one full cycle of inventory turnover during a year. But the average at the moment is below that. And so again, that's an indicator that jewelers bought a lot of inventory in the recovery period and don't necessarily and are not making the same level of sales that would justify such aggressive selling in hindsight. And so that's, again, another factor that would feed into them being more cautious about going into the wholesale market and buying. Just quickly, because I want to give some time for questions. In terms of, and this is something I was speaking to Shimon, who, a lot of the ideas that I present, I discussed with Shimon Gerstensang, who's the head of our pricing division at Rapaport, and really gives great insight to what's happening in the market. But when we talk about jewelers not needing to hold inventory because they can showcase their inventory in a digital format in the store when they speak to customers. Another aspect that is kind of a new thing for me, I hadn't heard this before, but it's kind of creeping into the let's say lexicon of the industry, and something that we need to look into more, that jewelers maybe are using lab grown in their store and then offer, as a try on mechanism, and then offering that, offering the equivalent of the natural, which they could then order from their supplier in the wholesale market if the customer wants that natural diamond. So it's kind of interesting, and let's say it's not something that's happening, but it's maybe a question that we need to look into. That are are jewelers holding or shifting to holding lab grown as a sales mechanism for natural? I'm not sure if it's a good or a bad thing, but it's kind of interesting. I'm also not sure to what extent it's happening, so take it with a grain of salt. Overall, all these factors that do affect, including the growth of lab grown, and the growth of lower price points at the moment. Jewelers are selling, but they seem to be selling, lower price points, and so that affects the type of inventory that they might be buying. And so when they go into the wholesale market, maybe they're not looking for natural diamonds to the same extent in this current market conditions, but are tending more towards colored gemstones or lab grown or gold jewelry, which we understand is having a good moment because of the investment sort of hedge aspect to it. Okay, so back to that original question, and I'm adding another element to it, if that wasn't enough. We spoke about lab grown, and again, I would take it as if I was to guesstimate the percentage that lab grown is affecting the diamond market slowdown versus the economy, I would say that it's 20-80, that 80% of the caution in the market is due to the economy, and maybe 20% of the lab grown, and that's a guesstimate. I say it to illustrate the point that I really do believe that it's the economy that's really having a greater impact on the slowdown in the wholesale market. But there is that other element. We've only spoken about the United States. Often in the past, when the US was slow, we often had the converse in China, that the Chinese market was strong and sort of pulled the market through. But what we're experiencing at the moment is a bit of a slowdown in both. That initial recovery that we saw or that initial sort of boost, that's the reopening of the Chinese-Hong Kong border, the reopening of travel for Chinese tourists, etc., had on the market at the Hong Kong show in March, that was very short-lived, and there's still this sort of caution coming out of China. And it's not at pre-pandemic levels. And an interesting little tidbit that I picked up on today is that there's, the Chinese diaspora or the Chinese tourist has a big influence on international jewelry sales as well. Those brands with the flagship stores in Hong Kong, in New York, in London, wherever it may be, the China, pre-pandemic, the Chinese tourist was a big driver of traffic to those stores. And so we look at outbound tourism from China, and it's still well below pre-pandemic levels. I should have picked up on the source for this, so I apologize in advance. But the article, let's say that I read, suggested that some outbound tourism is expected to reach 2/3 of pre-pandemic levels in this year. We are seeing numbers are down, at least in the first quarter. Chow Tai Fook's calendar first quarter, same-store sales down by 5.6%, volumes down 12%. It's a bit of an unfair indicator, that because the border reopening only, or the end of China's no COVID policy or zero COVID policy came mid-February, and so the quarter was influenced by those shutdowns that were still in place in mainland China at that time. There is an improvement that is expected after the border reopened in February, and we've got to give it a bit of time. I think it would be unfair to give a bottom line sort of decision on what's happening in China, but certainly at the moment there is feeling that that the market is down, both at a wholesale and a retail level in mainland China. And as with all wholesale buyers, the Chinese are generally quite cautious to buy into a downward trending market because of that concern that the value of their inventory will continue to decline if prices continue to decline. So there is also that element of caution out of China. And so we have that combination of uncertainty, economic uncertainty, both in the US and China, that are combined to impact the slowdown in the United States. Sorry, in the diamond wholesale market. So just a quick look ahead, and I was thinking while preparing this, do I make predictions? How can I make predictions? Is there a crystal ball? And it's just an impossible task. But I would alert you to certain things that we know about the second half. Firstly, there are key events that have the potential to lift the market up a little bit, or at least lift sentiment a bit, or reinforce the negative sentiments, frankly. So I do think that whatever happens at the Vegas shows, that they will be the Vegas shows this year will be a strong indicator about for what we can expect in the second half of the year. They're happening in 2 weeks' time. 1st of June to around the 4th, I'll be there. So be sure to track me down and say hello, give me a hug. Need a hug. And it'll be great to see you. So the other thing is the Hong Kong shows in September are always an indicator of the Hong Kong market. It'll be interesting to see as we head towards the next Chinese New Year, which is generally January or February, whether we've given the Chinese market enough time come September to get out there and start trading again. So those are two big events that I'm looking out for, and really have marked in my calendar as something that will give me greater insight to what's happening in the diamond and jewelry market. And then there's the second half of the year, which generally does have a more of an upbeat sort of feel to it. The second half is typically a more optimistic period for the industry as the holidays stimulate trading activity. That said, all the seasonal ups and downs that we usually experience have not occurred this year. That first quarter post-holiday season boom we didn't experience this year. So but let's look at the glass half full, and hope that the market will indeed adopt a more optimistic mood, starting with Vegas and moving into the holiday season across the globe. So I hope that gave you some insights, if not any definitive answers, but as to what is happening in the diamond market and in the jewelry market. It's always more nuanced than we theorize, but I certainly enjoy these discussions. So thank you for your time. Reach out to me. My email address. I'm on Instagram. I'm on LinkedIn. I'm on Twitter, but less active on Twitter. But feel free to reach out to me. And as I said, come shake my hand in Vegas if you see this tall, bald head bobbing around. So let's take some questions before we close up. Again, if you have any questions, please put them in the Q&A, not in the chat, because I'm just going to focus on the Q&A section. Okay, sure. Try to keep your questions concise because they're easier to read if they are concise, but let's go. From what I understand, the undertone is on the weaker or downside. Let's assume you keep reducing the wrap prices, which I believe is the right thing to do, especially in the current market. But even after that, if discounts still continue to be weak, then what's the point of correcting? And how do you see the market around 3 months down the line? So yeah, I mean, look, when we look at the Rapaport price list, our goal is always to be as honest as we possibly can in having the wrap list reflect what's happening in the market. And so, you know, so we see it as a reflection of what's out there, what's happened already in the market, and what's happening right now. So if discounts do continue to rise, if, in other words, if prices continue to decline, then we would need to reassess the price list. But we do so on a continual basis, and I can't say whether we will or not. I'm not on the team that looks at the price list and makes those decisions. So certainly don't take anything I say as an indicator of of what we're going to do. But look, if prices are dropping, then prices are dropping, and so you got to keep on top of things. That's why I think these discussions are so important. What do I think? How do I see the market around 3 months down the line? As I said, I think it's impossible to make any predictions in this market, but we do hope that inflation will get under control. I personally hope that the Fed has now ended its cycle of interest rate increases, which seems to indicate that it has. We'll see, and we'll see it in Vegas. You know, I really do think that the Vegas show will be some sort of an indicator of how we can look at the next 3 months. Okay, let's move on. With the rough prices coming down and currently no new rough, at least from the deferrals, do you still think that a polished correction is warranted or required? And how much in terms of percentage of correction approximately do you see in the next few months? And if demand doesn't improve, rough continues to correct, and polished discounts stay highly volatile and negative, then will you continue to correct the wrap prices? Yeah, I think that's pretty much the same question as the previous one. I can't make any predictions. I can't say what we're going to do on the price list. But you know, to relate it to the rough market, we are seeing a lot of caution on the rough market. De Beers put their numbers out today, actually, for the May site, or their May sales were down 21% year on year to $480 million worth of rough that they sold in May, which again, the comparisons are high. Last year was in May, we were still in that in that positive mindset, and the market was still doing pretty well. It was, you know, in May 2022, De Beers sold over 600, and I forget the exact number, but it was a big site last year. And so so there has been a drop-off in manufacturing. We understand that the Indian manufacturers have reduced their manufacturing levels. But again, just think about those slides that I presented at the beginning of the webinar, that those polished inventory levels are still relatively high. And so it's understandable why the rough market is slow and there's a reduction in manufacturing, because, you know, they have enough inventory for now. Okay. Okay, I'm going to move on because the next question is from the same person. So I'm going to just skip that and give others a turn. Okay, so hi, Avi. Hi. When you saw lab grown is down or is around 10% of the jewelry market, are you talking all categories? Do you have a percentage estimate of what lab grown represents for the diamond category? Thank you. It's a good question. It is my understanding it's about 10% of the total jewelry category. I don't have an estimate. Actually, you know, I'm going to pass on answering that. I need to check that. I need to check that number, that question. I'm actually not sure. So let me get back to you on that. I'll see how we can publicize that piece of information, but it's a good question. I'm not sure the answer to. Okay. Is it true that gemstone industry has survived different periods since we declared stones of value, but we are the ones give its meaning and value. So is it possible that the future generation who are moving toward a more minimalist life will make the diamond industry less valued rather than totally devalued? This will not be possible than it has been, less valued than it has been. I don't know if it's true that the next generation is becoming more minimalist. I think you just got to look on Instagram and Facebook and whatever else and see how consumer, that it's still a consumer market out there, and so I don't know if that's true. I think what is true is that there's a different mindset to consumerism in Gen X, Gen Z consumers. They are more aware and sensitive to environmental issues and to what the values of the brand. How is the brand contributing to society? What are the values behind the product that they're buying? And so I don't think it's a matter of being minimalist. It's a matter of being more value driven, and that's what's changed in the next generation. And so therein lies the challenge for the diamond industry: is you've got to show the value of what the diamond represents. And I do think that we're seeing the strong movement within the diamond industry towards traceability and responsible sourcing, and the technology is driving that capability to show the values of the diamond that enhances the story. And so I do think that the next generation of consumers will respond to that. So it's changed, but I do think there's always more to do. But there is a strong trend, at least, to move in the right direction. It's a good point. Haven't CZs been used in retail stores to show the size and proportion in a semi-mount ring? Yeah, it's a good point. It's a good point. I take it. And it's probably. If we think about the original question that I was putting forward in that slide about retailers using cheaper goods to enable the try-on experience in the store, and then ordering the natural diamond once the order has been made, and because they're being more cautious about the jewelers being more cautious about their inventory management. So CZs, I guess, would be a similar thing. I guess the difference is that with a lab-grown diamond, you could probably come closer to the look and feel of the diamond. That might be a controversial statement. I'm not sure. Okay. I wonder too if higher gold prices are affecting diamond purchases. Jewelers have increased significantly, especially in the. Could one factor be that metals prices are taking up space in their budgets that they might have spent on diamond inventory? In other words, when we say that jewelry retailers aren't spending to replace their inventory, is that all of their inventory or just their diamond purchases? Well, my context is the diamond industry, and I'm trying to understand what's causing the slowdown in the diamond wholesale market. And so your point is valid that it's to say that there maybe is there is a change. Retailers are probably are replacing their stronger sellers, and we understand that gold jewelry is a stronger seller at the moment. So so maybe they are responding to that. If that answers the question. Okay. Okay, we'll take 2 or 3 more questions before we close up. We're already over time. A while ago, I signed up to have my stones available for the Chinese market with RapNet. How is that going? I haven't had any requests of sales, but wonder how that program. I actually can't answer that. That's something you need to call up and speak to your RapNet customer service representative. I'm not going to get into specific RapNet issues in this call. Do you think the G7 will implement new sanctions on Russia that might meaningfully reduce their diamond exports? Well, I think the expectation is that the G7 is going to strengthen its disclosures of goods that come into their those respective countries, and so that would require a that then would sort of strengthen the sanctions on or strengthen their blockage of Russian goods coming into their markets. And so we don't know what that's going to look like. We'll hopefully know next week. We'll hopefully know, but the assumption or the speculation is that they are going to require people to make certain disclosures on the source of those goods, the source from at the rough level. But again, we'll have more information next week, I hope. The meeting, I understand, is over this weekend in Japan. Please speak to the so the question is, please speak to the current wholesale demand for melee bluffy goods and higher quality goods. I didn't go into specifics in this webinar, and so I don't want to go into those specifics without the proper research. So I'm going to pass on that question as well. But again, maybe we can, if you want to email me, we can with some specifics. We can look into it more closely. Yeah. So do you think Chinese retail groups like Chow Tai Fook will begin to sell lab-grown before Q4? Thank you. I think eventually they will. They've been very well. Firstly, lab-grown. The growth is in the US market at the moment, and that's essentially the market. So those other sort of maturing markets like China and India are not seeing that same level of demand at the retail level. So we don't see that those big chains like Chow Tai Fook was quite outspoken actually initially about not, well, I guess as everyone was, we'll never carry lab grown. I'd be surprised if it's this year. But I think it will come at some point that Chow Tai Fook will introduce something. But that's, again, it's speculation. It's not based on anything specific or any knowledge that I have. I'm just making the assumption that I think eventually, like as Signet did in the United States, as many other retailers did, as many wholesalers did, as many mining companies, including De Beers, or at least as De Beers has done, that they have sort of warmed to the product. But I would be surprised if Chow Tai Fook do it this year. But we'll see. You never know. Do we have more historical data regarding the price index for diamonds other than the 3 years provided in the presentation? Yeah. Rapaport has data that going back 40 years that we've been tracking, that we've been publishing the price list. If you are a subscriber to the magazine, our January edition of the magazine gives a 40-year history of diamond pricing. So that's every January, and that's available for a one-time purchase as well. I became a salesman, but it's something that we do. We couldn't analyze the market the way we do without that longer historical context and perspective. And you saw in the earlier slide, the 1 carat, as always, shows a graph showing the 1 carat RAPI index going back to 2008. And so we absolutely do have more than 3 years. What do you think about selling online through different platforms? Is it going to replace, or is it going to be less physical stores in the future? So the one thing we have seen in 2023 is the return of in-store shopping, and in-store presentation. And so while during COVID, we saw the spike in online, in e-commerce sales at retail, because people had to, because their stores shut down. They, and that sort of e-commerce trend continued through the last 2 years. But this year, there's a pent-up demand to go out and shop physically. I know from myself, I don't enjoy, it's a different experience buying online and in store, and I do value the personal, the subtle personal attention that I get. I absolutely despise overpowering salespeople, but I enjoy the subtle help that I get in a retail store. But we are seeing a very strong trend back into the store. The difference, though, between pre-pandemic and post-pandemic is that it's not about just the in-store experience and just the online experience. It's a combination of both. Omnichannel is the full digital experience, and so there's more digital engagement in the store. There's the digital engagement to get you to the store, and that's where it's changing. As part of the research that I did for my article in the research report and in the magazine, it seems that currently online jewelry sales are about 13% of the total, at least in the United States. And it seems that's and it's thanks to the Edge for this insight at the Edge Retail Academy, that there is this sort of feeling that that's kind of where online, where e-commerce is settling for not only jewelry, but also for the luxury market as a whole. And so the challenge for retail is not to differentiate between online and in-store. It's to really mesh the two and use the full digital experience to ultimately sell in-store, because that's where the consumer is going to be at the end of the day. Okay, let's do the last question. Okay, so that is the last question. Thank you so much, everyone, for your attention. I've gone over time as always. I'm not a big talker, but when I do talk, I tend to go on. I hope I didn't bore you. I hope you got some insight to this at this webinar as to what's happening in the diamond industry. Again, let's continue this discussion in Vegas. So I'll be happy to hear from you on your takes about what's going on in the diamond jewelry market, and that can hopefully feed into our analysis moving forward. So thank you for joining me. Thank you for your time, and it's greatly appreciated. And I look forward to seeing you all soon. Have a wonderful Vegas show. Have a wonderful second half of the year, and we'll see you next time. Bye-bye, everyone.